Evidence-based investing is much more rigorously tested and more robust than those traditional active approaches.
Why do you think so many people continue to push the active strategy so much?
I think that's important for investors to realize is that when investors are agreeing to transact, they're taking into account what the likelihood is of a whole host of occurrences in the future. The outcome in markets is always going to come down to what occurred versus what was the expectation going in.
What are some of these factors that would give us higher expected returns potentially?
I think it's a great question that frankly, I don't think anyone has the exact answer to. For a retiree, one of the biggest risks is going to be...
Welcome to another episode of Your Retirement Planning Simplified. Today on the show, I'm excited to welcome Wes Crill from Dimensional Fund Advisors. So Wes, welcome to the show.
Yeah, excited to be here. Thank you for having me.
Oh, no, I'm excited to have you. So before we jump in here, Wes, for our listeners, can you tell them a little bit about yourself, your role at Dimensional, and maybe why they should listen up today?
Yeah, maybe we can just start with who Dimensional is. So we're a systematic investment management firm. We've been around since 1981. We specialize in taking some of the big breakthroughs from academic finance and translating them into real world investment solutions. So I've been doing that for more than 4 decades now. My role at the firm has evolved a little bit over the years. So I started off actually within our research group. And so I conducted a lot of empirical research trying to understand the drivers of stock and bond returns, how to build and design strategies to capture these sources of returns, and also weighing the trade-offs of different investment strategies. And this led to a big part of my role now, which is serving as a spokesperson for the firm and meeting with our clients and prospects and having these kind of conversations with them, talking about the merits of different investment approaches, asset allocation decisions, and things of that nature.
Awesome. That's perfect because that's a lot of the stuff we want to talk about today. So,
hope so.
All right, let's just start maybe from a really high level. So one of the, the reasons that we really like working with Dimensional and all the things that you're doing is just coming back to the evidence, right? So could you talk a little bit about what evidence-based investing is and maybe how it's different from what a lot of people think of when they think of investing and trying to outperform the market or that more traditional active management?
Yeah, this evidence-based investing concept, which is something that I think would generally apply to what Dimensional does, this was an outcropping of some of the original research that was being done. If you go back about 50 years ago, this was really the beginning of people having the computing power, the data to really understand the behavior of stocks and performance of stock markets. As funny as it sounds, if you go back more than about 50 years ago, no one really knew what the return was on the market. There just wasn't really this level of data and computing power. And so over time, the breakthroughs in that sort of empirical science provided an evaluation tool for benchmarking managers. And some of the original studies around the performance of actively managed strategies. And what I mean by that is the traditional route of trying to select stocks or time markets based on the research you're doing, based on trying to gain an edge or get information the rest of the market didn't have. Well, for a long time, it was impossible to know whether they were actually adding value or not. But once we actually had the data, what we'll call evidence on the performance of markets, we were able to show that by and large, these traditional methods of trying to outperform markets were not successful. So evidence-based investing was really using or building investment strategies around what you could see in the data. So we can see, okay, for example, on a systematic basis, what kind of stocks and bonds are offering historically higher rates of return. And so you can use a broadly diversified portfolio of stocks and bonds to pursue these things that we see in the evidence of the data in a way that doesn't boil down to, I have a better call on the market than someone else. And so that's what I think about evidence-based investing is something that's much more rigorously tested and more robust than those traditional active approaches.
Okay, perfect. And can you talk a little bit about why is it so hard to outguess the market and how markets incorporate data to make it so difficult?
Yeah, the big part of it is just the amount of trading and, just the amount of activity that takes place within markets. So in 2024, there was almost $800 billion worth of in USD in volume that was transacting every day in global stock markets alone. That's just stocks. Bond markets are even larger. So if you think about what's taking place with each one of those trades and that vast amount of trade volume, you have a buyer and a seller, and they're coming together and they're agreeing to transact at a price that they both believe is fair. Now, they arrive at that assessment of whether a price is fair based on their expectations for the future. Whatever information they have, they might have a small piece of the information puzzle, certainly not the whole thing. So the function of the market in this vast amount of trade volume is to aggregate up all of these disparate viewpoints. And what effectively that does is produce prices that are the best guess or best predictor of the future because of the wisdom of the crowd. So if you have something that is reflective of so much information out there, it should really be about a 50-50 proposition that you can do better. Now, of course, if you're paying fees to try and make those guesses, it's going to be less than a 50-50 proposition. So we would not expect that there would be low-hanging fruit when it comes to markets that could be timed or stocks and bonds that could be picked. And when we look at, like I mentioned earlier, the evidence around actively managed strategies compared to just plain Jane broad market indices, very few of them have been able to consistently outperform. And we really don't find much in the way of persistence for even the ones that do outperform. And so that's consistent with a very competitive market where it's just very difficult to find something that these millions of other people have not been able to uncover.
And so why do you think that, and I know this is becoming more and more mainstream, but why do you think so many people, maybe specifically on like Wall Street or Bay Street here in Canada, why do they continue to push the active strategy so much? What do you think is behind that?
I think it's a great question that, frankly, I don't think anyone has the exact answer to. We do know that there's been some movement towards more and more investors wanting to embrace market prices. And when I say that, I just mean either tracking an index or using a systematic investment solution like the strategy Dimensional employs, where we're starting with market prices and building strategies around that. Last I'd seen, we're over 50% in terms of the managed asset industry being indexed. But there's still a lot of investors out there who have not really made that switch. And I think it could boil down to a number of things. One, it's just very tempting. There's a lot of gray area in the data. The data is not black and white to say that there is nothing out there that can tell you anything above and beyond market prices about expected returns. It just happens to be pretty noisy stuff. And so when you have noisy data and you have lots of people looking at it, people are going to come to different conclusions, different interpretations of what the data tells them. And I think there's always an appeal to some traditional active methods of trying to outperform markets because they have good stories associated with them. Sometimes there's stories that are going to resonate with investors. They'll say, well, we've got these tariffs that are going to be imposed. I think it's going to do this through my economic model. And that means these kinds of companies are going to fare poorly. These kind of companies are going to fare well. And we can take advantage of that in our investments. We would argue that if someone knows that, someone has a model that's predicting that, the market as a whole has already priced it in. But you can see how that story might be a pretty easy sell with some investors.
Yeah, no, it's fair. And I think just from experience, I think when things get scarier, even more uncertain than normal, I think a lot of people are looking for like, how can we work harder or do something to avoid this, right?
Yeah.
Maybe could you talk a little bit about why, when we hear that there might be a recession coming or, Trump, we're worried that he might do something different with tariffs, whatever it is, why is it that and I know you've already broadly talked about this, but maybe if we look at one of those specific examples, why can't we take that into our decision making of whether we should be buying or selling or trying to time things?
Yeah, it's certainly when investors are agreeing to transact, when they're setting prices for securities in the market, they're taking into account what the likelihood is of a whole host of occurrences in the future. Certainly one of them would be impacts to the macroeconomy. Certainly you could connect that to the potential for tariffs. So again, when they're setting prices, they're thinking about, okay, what is going to be the economic impact? Are we going to have a slowdown in terms of economic growth? Which kinds of companies are more likely to weather the storm than others? So markets, because they're forward-looking, are pricing these things in. Right. And that's good news for investors because recessions are called on a lag. The National Bureau of Economic Research that defines U.S. economic recessions is going to be using backward-looking variables. The market is going to have already moved ahead of time. And certainly you see this when you look at recessions in the U.S. The National Bureau of Economic Research has been formally identifying changes in the business cycle since 1979. We've had 6 recessions in the U.S. since then. In 4 of the 6, the market had already bottomed out by the time they actually called the recession.
Right.
There's typically going to be a market downturn as markets readjust the prices they're willing to pay in light of worsening economic conditions. But by the time the recession's called, they've likely already moved on. And certainly that was evident in 2020 when we saw markets globally just going on a tear, really starting in the beginning of April 2020. And of course, the recession gets called, maybe a month or two later. So I think that's important for investors to realize, is that the outcome in markets is always going to come down to what occurred versus what was the expectation going in. If the expectation is pessimistic for whatever it might be, the macro economy, that means that if that does come to fruition as expected, you can have a good outcome for markets. If things end up being better than expected, like the news is maybe still bad, but not quite as bad as they expected, then you get a really good pop in markets. We've seen that a couple of years recently. If the news ends up being worse than expected, and I think to a large extent, maybe this was the case with the tariff developments in early April, that's when you can get a market downturn, when the market is repricing because the expectations have changed. So most recessions, if you start looking at market returns in the first month of a recession, more often than not, investors have had a positive growth of wealth over the next few years. And I think it's because of that forward-looking nature.
Yeah, I think that makes perfect sense. Well said. Okay. Now, you talked about this idea that it's really hard to do better than the indexes that we're measured against or managers measured against. Can you talk a little bit about the difference between, say, an indexing strategy and something more on that systematic approach, I think is the word you use, but like thinking about other factors or dimensions of return, and how you would or could look at securities to find maybe higher expected returns than just the index?
Yeah, I think when you're trying to pursue higher returns than the market, we know historically that trying to pick which stocks are undervalued, unlikely to succeed. Trying to time market movements, unlikely to succeed. But we believe in a well-functioning capital market, there have to be differences in expected returns. It has to be the case that investors are going to demand a higher rate of return for some kinds of companies than others. Like, for example, they're going to demand a higher rate of return to hold the stock of a company that is in a precarious financial situation, maybe entering bankruptcy, than they would for Apple, a much stronger type of company. So there have to be systematic differences in expected stock and bond returns. And a lot of the research that has been conducted over the past few decades has been devoted to uncovering what are the signals, what are the characteristics for stocks and bonds that will tell you on a systematic basis which ones should have higher or lower returns. Clearly, there needs to be a high standard for this type of research, a lot of rigor involved. You also want to combine the data that you're uncovering with some sort of economic theory behind it. But when you have those types of what I'll call sources of higher expected returns, then you can start to design portfolios to pursue higher returns than the market by overweighting or emphasizing these companies with higher expected returns, and then maybe underweighting or de-emphasizing the ones with lower expected returns. And that's a way you can pursue higher expected returns in a way that, and this is the kicker, you're taking market prices as a given and extracting the information they're telling you. And this is antithetical, this is polar opposite of the traditional active management lens, which was, I'm going to start from the premise that I think a lot of these market prices are wrong. So I think it's refreshing. And the beauty of this is it can be done with a lot of what people would consider the appealing traits of traditional indexing. So you can have broad diversification. You don't have to have a 5-stock portfolio. You can have low turnover because these characteristics that are telling you about stock and bond returns are long lasting. They can tell you about differences in returns for years at a time. And you can have low fees associated with this. Maybe not as low as an index fund, because index funds are typically outsourcing the investment process, but you can be much lower than traditional active methods of pursuing outperformance. And then again, the other key distinction between what I'll call systematic investing that would be classified as active compared to index funds is taking away the rigidity of the index fund process. So if you're managing an index fund, you are, as I mentioned before, outsourcing the investment process. You're having an index provider, whether it's Standard & Poor's, whether it's MSCI, they are telling you what to buy and when to buy it. And that means two things. One, you're going to have to do things on particular days, regardless of whether your execution is going to be good. And it means that in the interim, you could actually be drifting in terms of your style or characteristics. You could have less overlap with the intended asset category than you might otherwise have. Whereas if you have flexibility in our investment approach, we look to be able to do things on a day-by-day basis so we can be more consistent with the investment objective.
Yeah, could you talk maybe a little bit more about that? So there's the cost that everyone thinks about, right? There's like that management expense ratio, but there's also, market impact costs and other things like that. So could you talk a little bit about, when we're thinking about researching our investment options, what are some of the costs that may be higher? And I know you just alluded to it a little bit, but what are some of the costs that might be higher that we're not really seeing on a prospectus from an index fund like an S&P 500 ETF, for example, versus the way that you guys are implementing on a daily basis?
Yeah, and these costs come in different layers. And I think, the most obvious one that a lot of people are going to focus on would just be, that management expense ratio. And like I mentioned, for index funds, that's going to look very, very low. But there's many other costs that are going to be embedded, specifically with the indices themselves. So what we see when, for example, indices are being what we call reconstituted, or they're being redefined in terms of what securities are eligible, how much they should be held in proportionality. And when they make these changes, what has to occur basically immediately after is the funds that are tracking these indices have to follow suit to avoid having tracking error or differences versus the underlying index. They have to do the buying of securities that are being added, do the selling of the securities that are being deleted. And because that's happening in potentially very large quantities, they're pushing prices. And what's interesting is you're going to see this impact on security prices, the ones that are being added pushed up, the ones that are being deleted getting pushed down. It happens in the underlying index returns, which means this is before you even get to the management expense ratio. And that's a cost investors might not always see, but that they're definitely going to be paying. And then the other element is just the opportunity cost. And what I mean by that is when you have drifts from the intended characteristics of the asset class. Say I want a small cap value portfolio or a large cap growth portfolio or something like that. Well, as you go through this period of time in between these reconstitution events, when the index is still as however it was defined maybe many months ago, you could have securities that are drifting out of that asset class but still being held by the index. And so you might end up with something that is not a accurate representation of really what the investor's objective was. And so these are costs that are sometimes hard to suss out, but over the long haul are likely to detract from an investor's return.
Okay. Now you just mentioned like small cap value as a potential asset class. Could you maybe talk, shifting back to, again, the higher expected returns? Like what are some of these factors that would give us higher expected returns potentially?
Yeah, we have a framework for where we should be looking, what kinds of characteristics should have information about security returns. And it's just basic valuation theory, right? It's like, what do I have to pay and what do I expect to receive in the future? And the beauty of this framework is it's evergreen and you apply it everywhere. When you go shopping for pants, cars, watches, homes, you're not just looking at whatever the lowest price is, you're also looking at the price in combination with what you expect to receive. So the nice thing about that framework is it tells us that if we have characteristics, let's just use stocks as an example, they're telling us about the price I pay for that stock and what I expect to receive in the future, then those really should be related to differences in expected returns. I'm less prone to a data mining error or finding something that's totally spurious in the data if I can connect the dots to one of those two characteristics. And so in the case of stocks, we have really three, what I'll call core drivers of returns that have been uncovered over the decades. The first is size. So that's just company size or market capitalization. So you take the price per share, multiply times the number of shares outstanding. And again, if my intuition is that low price should be associated with higher return, my expectation is that smaller companies will have higher returns over the long haul than their larger brethren. Another price variable is what we call relative price or valuations in the parlance of the industry. So that suggests that a low, and if I'm scaling price by fundamentals such as book equity, say a low price to book stock or what we call a value stock should have higher returns than a corresponding high price or growth stock over the long haul. Profitability, which is the more recently discovered of those three, the seminal paper around this was actually in 2012. Profitability is giving you information about the other side of the coin, what I expect to receive in the future. So all else being equal, the more profitable a company is, the more cash they have to return to investors. And so the profitability characteristics are telling me something about what I can expect to receive in the future. And the combination of those three characteristics, size, relative price, and profitability, are giving me robust information about expected returns that I can use to build portfolios that can target higher returns than the market.
Perfect. And you mentioned robust a couple of times. So how do you differentiate between something where we can expect these higher returns and we have the data maybe from different markets, different time horizons versus something that's more of a marketing gimmick that's been data mined that really isn't going to be maybe going to be that reliable.
Yeah, and the first step is to figure out, okay, should I have expected this observation in the data before I found it? And that's why I did want to emphasize that valuation theory framework, because that's really our safeguard against data mining. But you also want to check to see, how robust, how sensitive any of these observations are to the experiment I'm running. So, for example, let's take price to book ratio. We see that if we sort companies on price to book, historically, we see differences in average returns. Well, what if I slightly change that ratio? What if I changed what's in the denominator? What if I ran my experiment rebalancing at a different frequency? So one of them is sorting once a year, one of them is sorting every month. What if I look outside of my original sample? So I go from, say, US stock data to looking at Canadian stock data or European stock data. If this relation completely falls apart when I get to different markets, that starts to lead you to question the reliability, the robustness of the observation. So you want to see that this thing shows up to a large extent, regardless of what the experimental setup is. And then you also want to be able to find insights that translate into real world investment implications, right? If I find something that involves turning over my entire portfolio every single week, or only holding 10 stocks to maximize the return, or if I have to equally weight stocks instead of using something that has more reasonable turnover characteristics like market capitalization weighting, things like that. By the way, all these should be red flags not that your audience is going to spend a ton of time reading academic papers, but when you start to see these kinds of things where they're rebalancing, weekly, and they're using equal weights and they're only looking at one industry, you should start to set off alarm bells that maybe whatever they found in that particular sample did not translate anywhere else.
Yeah, that's perfect. Now, the other thing, when we think about higher expected returns, we typically think about more risk, right? More risk, more return. So how do these different examples, like the relative price, capitalization, profitability, like how should we think about that from a risk standpoint? And are there trade-offs there?
Yeah, this is a fantastic question, because especially when you're thinking about for someone who's entering into retirement, it's one of the most common questions I get, which is, okay, I believe risk and return are related. He told me about these things that can increase my return, but I don't want to increase my risk right as I'm going into retirement and I no longer have the ability to replenish my savings. So I always like to clarify what risk we're actually talking about here. We know that there is some sort of underlying risk probably that's driving a portion of these return premiums we're observing. But there's many different types of risks out there. And for a retiree, likely one of the biggest risks is going to be the volatility of the portfolio. I know that as I widen the range of outcomes for my future wealth level, then I'm potentially, applying some risks that I won't be able to meet cash flows in the future, or, increasing the probability of a shortfall in my savings in the future. This is where the good news comes in when it comes to pursuing these premiums, because not all of them bump up your volatility. When I emphasize smaller stocks within an asset allocation, I do tend to get a little bit of an increase in volatility. But when I apply profitability considerations and emphasize higher profitability companies, I actually do the reverse. I tend to reduce the volatility of my asset allocation. And applying value considerations or emphasizing value stocks versus growth stocks tends to have very minimal effect on volatility. So the combined outcome there is, if you have a market-wide, what we sometimes call a core type of allocation, but something that holds most of the stuff in the market, but it's overweighting simultaneously small caps and value stocks and high profitability stocks. Here's the beauty of it. It tends to have very similar volatility to the broad market. So if I replace my just broad market index with this type of systematic strategy, I actually might not be moving the needle for my volatility, but I'm going to be increasing my expected return. So that's a great trade-off for someone who is considering volatility as a primary risk. I think the main risk, by the way, if I had to name one, is, and you might wonder, why doesn't everyone just pour into small cap or value or high profitability? Well, if you ask someone how small cap value has performed in the US over the past 20 years compared to large cap growth, and if they've looked at the US market data, they might say, well, hasn't been a banner couple of decades, because there could be long stretches where these premiums I'm pursuing don't pay off. I think that's the nature of really the trade-off in terms of pursuing these. It's not going to necessarily increase your volatility, but it can increase really your shortfall versus a broad market index, what I'll call FOMO risk, as my kids might call it. So I think that's what keeps just everyone in the world from going into value, because if it were that easy, everyone would want to be a value investor. But the most common definition of risk seems to not be perturbed by that type of investing.
Okay. Could you maybe just like right on the exact same thing you just said, but just to make this really clear, like the importance of diversification in a portfolio, specifically for a retiree?
Yeah, broad diversification is essential for a variety of reasons. We know that generally speaking, it's going to help decrease idiosyncratic risk, which means if I have one company that's going through rough times and its stock price is falling, it doesn't drag my whole portfolio down because I have other companies at the same time might be faring well under the same circumstances. So the more companies you add into a portfolio, the less volatility you have coming from individual stock outcomes. It also gives you, as an investment manager, when we're trying to get good execution for our portfolios, it gives us flexibility. And flexibility helps us not trade when there is bad circumstances for a particular stock, or just, generally speaking, not have to trade in every single security every day, like, some index funds might during a reconstitution event. But one of the most, I think, underappreciated aspects of diversification is it helps you capture returns from the market in a more reliable way. We know just with the basic equity premium that not all stocks deliver the equity premium in a given year. You have some stocks with very strong returns, and then the rest of the market might have, zero or even negative returns. But the small subset of the market that delivered strong returns buoys the overall broad market's return for the year. So if I'm only holding a small subset of the stock market, well, if I'm not holding the ones that deliver the equity premium, then I might have missed out on the equity premium itself. And we see that's also true for those other premiums I was talking about, the higher returns associated with small stocks, with value stocks, with high profitability stocks. It's not all stocks in those asset classes that deliver those extra returns or the premiums. It's going to be a small subset. And without broad diversification, you might miss out on the ones that actually delivered it.
Yeah, that's perfect. All right. Now, switching gears a little bit, especially for retirees, a popular investment philosophy, so to speak, would be dividend investing. People might point to, good returns over time, being able to keep their capital in place where they're just living off of the income. So could you talk about why maybe those returns aren't as simple as dividend stocks do well, and also other considerations around maybe like tax treatment of dividends versus capital gains, or anything else you think we should be thinking about when we're building a portfolio to help fund our retirement?
Yeah, income sounds great, right? And I think really the key aspect here is, where is that income actually coming from? So when a stock pays a dividend, it's not coming out of thin air. It is being paid out of the economic value of that firm. In other words, the value of that firm goes down by the amount of the dividend. You can actually see this if you run an experiment with high dividend yielding stocks, where on the date of their dividend payment, their stock price falls by almost the exact amount as the value of the dividend. If the dividend's $1, the share price tends to go down by $1 on the same day on average. So what that's telling you is that there's really two scenarios here. You can have a non-dividend paying stock that, let's say you have $1,000 worth of that stock, or in an alternative scenario, you have a stock that's paying a 10% dividend. Well, on the date of that dividend, you've now got $900 of that stock plus $100 worth of cash. Now, that's basically economically equivalent to if I had the non-dividend paying stock, I had $1,000 of that. I can produce my own dividend whenever I want. I can sell $100 worth of that stock. I've now got $100 in cash, just like I did with the dividend paying stock. I've still got $900 of value in the stock remaining. So economically, I should be indifferent between those two. Now, the appeal for some investors is they think of these dividend paying stocks as maybe being more stable. And a lot of companies are averse to actually cutting their dividend. Maybe that's where some of the reputation comes from. But that doesn't mean that they are safe in the same way that we think about a traditional safe haven. Like, for example, bonds, which most people would think of as your portfolio stabilization agent, the thing you put in your portfolio to reduce volatility. Dividend paying stocks have nowhere near as low of a volatility as bonds. They have equity-like volatility. And their returns that you're getting in exchange for that volatility are, again, they're going to be higher than bonds, but they've not been as high as certain what we consider high expected return asset classes, like value stocks, like high profitability stocks. So it's not totally clear what advantage you're getting there, because that dividend is not coming out of thin air. You could produce that on your own. Like you mentioned, there might be tax equations here where you actually might prefer to not get the dividend. You might prefer to actually produce your own synthetic dividend, as I call it, by selling a stock, because then the tax bill you're going to get is going to be capital gains. Long-term capital gains might end up being better for you than the income the tax you're going to be paying on the income that you get from the dividend, depending on the circumstances associated with that. I think the even bigger boon for creating your own dividend is you get to choose when you do it versus a company that's going to foist that dividend upon you at their choosing. So I think those are some of the big considerations for investors when they're thinking about, should I favor dividend stocks versus non-dividend stocks? The last thing I'll mention, at the risk of belaboring the subject, is not all stocks pay a dividend. So in the U.S., for example, the number of companies that are paying a dividend is drastically lower. It's about half what it was 30 or 40 years ago. So what that means is if I have a portfolio that's only focusing on dividend-paying stocks, I've already forfeited a huge chunk of diversification. And then at the end of the day, it doesn't seem like the trade-offs are necessarily going to outweigh that forfeiture of diversification.
Yeah, it makes perfect sense. I think if we come back to some of those factors, a lot of times if we do see dividend stocks doing well, they're also often profitable value type
That's
companies,
exactly right. Yeah.
But there's a whole,
exactly right.
To your point on diversification, there's still a lot of other companies out there that might be more profitable and value like that we're missing out on your portfolio.
Yeah, that's a great point. This is one of the things we do when we're trying to assess the merits of an asset allocation or an investment style, is you want to first see if it's doing anything that you can't already get in another more maybe systematic or reliable way. To your point, what kind of companies pay dividends? Well, it tends to be ones that are highly profitable. It tends to be companies that are larger. So if I say, okay, well, I want an emphasis on larger companies with high profitability, well, I can do that in a very straightforward way by using market capitalization characteristics and profitability characteristics. And I don't start off kicking out 2/3 of the market based on dividend payments.
Yeah, exactly. So still thinking about investment strategies and thinking more in terms of our asset allocation in recent years, like maybe recent decade, I should say, we're seeing more and more alternative investment use, specifically for like high net worth investors. So thinking about things like real estate, private equity, infrastructure. What are your thoughts on that? Like, what does the evidence tell us about putting those into our portfolio? Do they have a place in our portfolio for retirees? What are your thoughts there?
Yeah, like most things, I think it probably depends on a whole number of considerations. I'll start with some of the research that we've done around just the performance of those private market asset classes, whether it's equity, whether it's debt, whether it's real estate. And I'll start off with a caveat that it's very challenging to do research on the returns of those kind of investments. They don't have the same reporting requirements as publicly traded managed funds. So you can get biases that creep into the data. Maybe not all managers would report their data to certain databases. There's ways around that, but then sometimes you lose the ability, like with the data set that we use, you only have the return data across vintages of different managers. You can't see the performance for individual managers. So it makes things like persistence of performance very difficult to test. But what we can glean from the data over the past 3 decades is that the average return has been what I'll call fairly strong for these different groups. Like, for example, private equity returns on average across the population have been roughly similar to U.S. small cap value, which, over that stretch of time had actually fared quite well. Its underperformance has really been in more recent periods. What's notable about the performance, though, is the range of outcomes. The dispersion is far larger for private market returns than it is for public market returns. So that means that you could potentially wind up in a much further to the left portion of the distribution than you might with public equity or debt or real estate markets. So that's something for investors to consider, because what it implies is a diversification trade-off is going to be a little mixed. The assets that are being held in private market portfolios are different than public market. They're holding different types of companies than what is available in, publicly managed portfolios. So that means that it is expanding your opportunity set in that dimension. But what you're trading off is a lot more idiosyncratic volatility, a lot more maybe investment specific outcomes because of that range of outcomes. So it's not totally clear whether the net contribution to diversification is actually positive there. And, you get to the fees associated with private market investing. I mean, they're going to be probably substantially higher than they are for publicly managed portfolios. And then, there's always the potential for adverse selection. I might not end up with, even for a good manager who has a good reputation, I might end up in the one bad vintage they have for, maybe their buyout strategies. And so All of these things I think should give investors pause. And I think it's challenging to get sufficient diversification across these things at a smaller scale. And again, that's why I think it's not a slam dunk in either direction. If you feel like you can satisfy all of those questions and considerations, you think you have enough capital to get broad diversification, you think you're going to be able to access the best vintages from the managers, you're not concerned about liquidity. People always say they're not concerned about liquidity until they need liquidity. Okay.
Yeah.
That's why, many like endowments have huge weights in these private market portfolios because they are hoping to never need the money, right? So you got to consider how liquid you are, how much liquidity you're going to need as an investor, and just many, many things that complicate the picture.
Yeah, no, that's great. Now, if we think about Dimensional specifically, how does Dimensional use the academic research and all the research you guys are doing at Dimensional? How do you guys use that to evolve your process over time rather than just the same thing over and over again?
Yeah, we're always looking to make our portfolios better on a day-by-day basis. And certainly the big ideas out there, the watershed moments, are often going to come from academic research. So we stay abreast of that. We've also worked hard to forge these academic connections. This has been part of our DNA since day one. We've worked with, I believe our count is up to about 6 Nobel Prize winners at this point. Now, the nice thing is that we started working with them before they got their Nobel Prizes. So we're not trying to ride on the coattails of their public awards. But what that's allowed us to do is really translate these insights in a more reliable way, because anyone can read these academic papers. They're out there in the public domain. But what really, I think, sets Dimensional apart since day one is our ability to dig deeper and to figure out what are all the other boxes I need to check? What are the additional insights that I need to uncover by kind of broadening out the research around these insights? And that's no small task when it comes to translating these academic insights. Now, I'll give you an example of that. So, for example, when we were doing the profitability research, the seminal paper on profitability was by Professor Robert Novi-Marx, and he showed that if I measured profitability at a gross profits level, so revenues minus cost of goods sold, scaled by assets, he saw that there was a difference in average returns when sorting companies historically. And he did it in a very robust way. He did it the way that we would expect a proper research experiment to be conducted. But we also wanted to know more. We wanted to know, okay, well, if I look maybe across different countries, across different sectors, looking through time, how persistent was this? How low or high was the turnover associated with this signal? So we wanted to run hundreds of additional tests on this to see, how would we want to evolve that measure of profitability? And we made some slight tweaks based on our internal research that we were doing sort of in concert with Novi-Marx. And so that's an example of how you have to go beyond what the actual academic evidence says. But we're also doing a lot of internal research, particularly on data sets that are proprietary to Dimensional. In fact, we've actually had academics who wanted to use the data that we had curated internally because we're so fanatical about the quality of our data. And sometimes you get data that you really can't find anywhere else. Like, for example, when we look at what we see from the securities lending activities for our portfolios, we lend out securities for market participants who want to borrow them for whatever reason. And we actually can find information in how much they're willing to pay to borrow these stocks that has information about short-term differences in expected returns. And that's not something that's available publicly. That is a proprietary data set. So that's really the level of research that we're constantly working on to improve our portfolios.
Awesome. That's great. Can you maybe just give an example also where just because something shows up in the academic research doesn't necessarily means it can apply in the real world when you're building a portfolio?
Yeah. I mean, sometimes things that look really good on paper need some nuance when it comes to the application in a portfolio. I think this is where sort of the framework of how to use different types of insights in different ways becomes critical. That, again, you're generally not going to understand just from the paper alone. Momentum is probably the primary example of this. For anyone who's not familiar with the concept of momentum, as the name suggests, it's stocks that have had relatively high returns over the past year tend to continue to have relatively high returns in the short term. And the reverse is also true. Stocks that have underperformed the market substantially in the past year tend to continue to underperform in the short term. So if you were to buy the winners, sell the losers, rebalance this thing, on a very high frequency basis, you're going to be producing very high returns on paper. Problem is, this is a very short-term effect, which means you're going to be doing a lot of trading, which is never free, and that's going to eat into your profits. And you're also not going to have much flexibility because of the high frequency nature of this for the securities you're buying and selling, which means not only are you going to do a lot of trading, you're probably likely to push the prices of securities if you deploy substantial capital behind it. How much that costs is very difficult to figure in terms of an experiment. But we think that maybe there's a more effective way to use that insight, which is not to tell me what stocks to buy, not to say, oh, I want to buy winners, I want to buy the losers. The way you can use this insight is in concert with the rest of the things in your process. So if I'm looking at a portfolio that's emphasizing value stocks, for example, one way stocks can become value stocks is they've been falling in price. So I look at all of the candidates. This comes back to this idea of flexibility. I might have, let's say, 2 companies that both check the box for a value stock, but one of them is experiencing downward momentum while the other one is not. Okay, well, I'm going to hold off on buying the one that's in downward momentum today, and I'm going to buy the other one today. And then I'm going to revisit the characteristics of the one that I passed on yesterday. And tomorrow, I'm going to reevaluate its momentum characteristics, and I can reform my assessment then. So I think of that as not telling us what to buy, but more of when to buy. And that fits into a whole suite of similar signals we have that are going to influence the timing of our trades. But the asset allocation, the underlying design of the portfolio is going to be based on what I think of as lower turnover or longer term characteristics like size, value, and profitability. Hopefully that distinction makes a little bit of sense.
Yeah, absolutely. That's the exact example I was thinking of actually is momentum. Because you see now like momentum investment funds coming out, right? But are they actually able to capture those excess returns?
Very few of them. Yeah, we've looked at a study. It's not always totally straightforward to capture all of these momentum funds because they don't always get a classification to say explicitly that they're momentum. But we can use things like the loading on momentum factors from an asset pricing model. You can use the name of the fund. If it says momentum or mom, then you have to make sure it's not something around Mother's Day. But, if you're careful about your methodology there. And when we looked at the performance of these funds compared to their Morningstar category indices, so we use that to control for style because oftentimes these funds will have a different style than the market. They might be growthy versus a broad market index.
Right.
And when you compare their returns versus the category index, the vast majority of them have actually had negative returns. And why that is troubling to me if I'm evaluating momentum as a style is that most of these funds were managed in a period of time where the momentum premium was very positive. So the opposite from the value premium, and they still weren't able to channel that into excess returns.
Is there any other advice you have for retirees or anything retirees should be thinking about as they're thinking about building their portfolio or adjusting their portfolio as they approach retirement?
Yeah, I think just being wary of if it sounds too good to be true, it probably is. I think anything that promises a strong return, but less downside or lower risk than something with a comparable return, you have to ask yourself why that trade-off would exist in a market. Odds are it probably doesn't. It's going to be giving up some return if it's sparing you some risk or some downside. So things like that. The shiny object, whatever the most popular thing is today. These type of fads in markets are usually called fads for a reason because they attract a lot of attention. A lot of people join the space, launch strategies, and it might not be around for very long. I think some of the low volatility strategies that were emerging out of the global financial crisis in the early 2010s, these were equity strategies that were trying to target lower than market volatility and get market-like returns. As you can imagine, that doesn't tend to portray itself or actually play out that way in the real world, just in back-tested simulations. So I think thinking simpler is probably better. Investing should be like watching grass grow or paint dry. It should not be like betting on a cricket match, right? You should not be looking for the most exciting thing. You should be looking for really the most robust thing, something you could basically ignore for the next 30 years and get a good investment outcome.
Yeah, that makes perfect sense. Making me think of another question we often get, which, seems like an obvious question to ask when you're exploring working with another advisor. So I would say our value proposition more than anything really is financial planning, right? Yep. But the question we inevitably get is, can you show us your past returns? Which is fine. We can talk about that, but could you talk a little bit about why someone asking an advisor about their past returns or how their portfolios would have done might not be the greatest question to ask when you're evaluating a financial advisor?
Yeah, to give you an extreme example, If you ask an advisor who had been providing equity exposure during the 2000s and say, well, why did you have a negative return for this portfolio in, the 2000s? Well, it's because the S&P 500 was negative for that 10-year period. And so where I'm going with this is you can have outcomes in markets that really shouldn't be an input into the decisions going forward because we can't control investment outcomes. What we can control is really the risk we're taking on in the portfolio, how broadly diversified we are, whether we want to pursue return premiums. And you want to make a decision that is separate from the actual outcomes because the outcome from a portfolio is going to have two components: the expected return from that asset allocation and also the unexpected return. The unexpected return is what happens when you get changes in expectations that deviated from whatever people thought was going to happen, good, bad, or indifferent. That can be, most years for stock markets, the return is nowhere near the long-term average. It's usually substantially higher or substantially lower. And so you want to be careful about evaluating. You want to understand the performance, maybe understand why they chose the investments they did and, why it deviated from the market. But you want to be careful evaluating on something relative to the broad market because of the role of things that happened in the past that have no bearing on the future. And to your point, I spend 99% of my time thinking about investments, thinking about portfolios and portfolio design, construction, asset allocation. To your point, what's going to control a lot of the variability of an investor's outcome is going to be the financial planning and you just being there as a North Star to ward them off of all of these shiny objects, to keep them from falling prey to these things that sound really exciting but are probably not a good idea. That's the true value of having objective investment advice in your life. And I think that's a great example that you point out of just being there.
Yeah, I think that's also probably the importance of, if you're doing it on your own or an advisor, but having an investment philosophy, right? Something to come back to rather than trying to chase performance and whatever, to your point earlier, like what's the shiny object or what has looked good over the last 5 years or whatever it is.
Yeah.
Okay. So just a couple things before we sign off today. Is there, and you may or may not have an answer for this, is there anything exciting that Dimensional's seeing, any new research coming out or new things you guys are doing?
Yeah, I don't want to get too far into this one, but we're always trying to evaluate how we're thinking about those, what I refer to as short-term signals or things that are momentum-like in terms of their duration. And there's definitely things along those lines that we're looking at incorporating in terms of implementation. I think it continues to be just sort of an evolution. Everything we're doing for our research is trying to improve incrementally from where we were in the past. And we're never going to stop doing that because I don't think you can ever have the perfect portfolio. We want to make sure that we're always pushing towards better and better expectations.
Awesome. And where can people find you, connect with you, or learn more about Dimensional?
So you can certainly find Dimensional by going to our website. If you just Google Dimensional Fund Advisors, you'll be able to find us. And you can find any of my stuff. You can find me on LinkedIn. I'm always trying to publish on LinkedIn. And I try and do a lot of these kinds of things, either, with our clients and prospects, also media outlets. So if you like what you hear, please come check out our website and try and take a look at our content.
Awesome. So we'll also put links to Wes in the show notes, retirementplanningsimplified.ca, and just click on the blog tab and find Wes. All right, Wes, I really appreciate you joining us today. A lot of good things for us to think about from an investment standpoint.
Yeah, this was fun. Thanks for having me.
Our pleasure.